Welcome in, everybody, to this week's episode of the Magnify Wealth Podcast. Here with your host, Scott Gannon.
Hey everybody.
Today, we're going to talk about a very particular type of institution. An institution that makes crazy returns in the effect of 3 or 4 digit percentages and has almost zero risk. I think they know what this institution is.
Yeah, that would be banks. We talk about banks a lot because we want to act like one.
So the question I want to ask about banks is, do they rely on compound interest? The thing that you hear all the financial gurus talk about, you even hear the banks tell you that you should be getting a lot of compound interest.
Yeah, so banks, they are very famous for, bring your money to us, leave it there, and you'll benefit from the magic of compound interest. But not that compound interest is a bad thing, but that's not what they're relying on to make their gobs and gobs of money. And what they're looking at doing is moving the money. So we're talking about velocity here. What I mean by moving is the money comes in, they send it right back out and lend it. And then when the deposits come in, they lend that. When the payments come in from other loans, they just put them right back on the street with a new loan. So what they're doing is using money over and over and over again. Again, velocity, it's about moving the money, not about sitting it or having it sit. So as an example, think of money as it's a product. So cash is a product. Just like a can of paint's a product, a hammer is a product, clothing are products, money is a product. So when you're in the banking business, your product is money. And what does money have as a benefit being that product is our world we live in has an insatiable demand for money. So you always have customers or potential people that need or want money.
If you look at the can of paint example, if paint had nearly unlimited demand in the way money does, wouldn't a paint store want to constantly be adding to their inventory and then sending it right back out so that they can make those gobs of returns in their business?
For sure. They'll want as much paint on their shelves as they can possibly have, just like money.
Exactly. Well, now why don't we bring up our visual example so you guys can really see how banks make this work.
Okay, so we're gonna run through here. So in this picture here, we've got the box here is a bank. So how banks make money? Well, first thing they do is they take in deposits. So Jack deposits 100 grand. And what's the bank gonna do with that money? It's gonna immediately lend it out to Jill. And what's Jill gonna do with that money? Well, it could be any number of things. She could have a credit card, business loan, car loan, consolidation loans, whatever. But what we're gonna focus on is mortgage. And we're gonna use a 6% as an example. So as you'll see here in the visual, the bank is taking in 6% from Jill. And we're gonna use the example in this example that the bank is paying Jack 1%. So what is the bank making in this scenario? And as you'll see, the difference is 5. So receiving 6 and paying out 1. So what most people think in that scenario is they earn 5%. And everybody that thinks that would be 100% right if the bank was using their own money. But because they're just simply renting Jack's money, they are making 500%. How does that work? Well, think of it in terms of the actual dollars instead of the percent. They're paying out 1,000 and taking in 6,000. So their expense is $1,000, or their cost of goods is $1,000. So their margin is 500%. Why? Because they took in 6,000 in revenue, 1,000 in cost of goods. You get the math. So if you had a $1,000 paint can, right, and charging 6,000 for it, your margin would be 500%.
Exactly. So now what we're going to do is we're actually going to flip over to show you how it's actually possible to act like a bank yourself and make the same kind of transactions that the bank makes.
Yes. So in this visual here, where you can be the bank too, and this is using your specially designed high cash value dividend paying life insurance policy that we talk about all the time. So in this example, we have cash value of $100,000, and that's earning 4 to 5%. And you can borrow up to 90% of that on demand against the policy, again, not from the policy, against the policy, so that you've multiplied the use of that money. What? 100,000 and 90,000, that's $190,000 working for you. But Jill is borrowing that 90K, and let's say that Jill is using that for flipping a house. So she's gonna do a private loan, and that private loan is paying 15%. Now, what's that 15%? It's probably a mixture of lending fees and interest rates, but generally it would be fully secured. So you borrow against the property, you take the property as collateral and you lend out the money to Jill. Put it back in, so you're borrowing. So in this example, we're taking about 3% net, and that is your difference. Like basically right now, you'd probably pay 7 or 8. We can get as low as 6.5, one of our suppliers, but we're gonna go with a net 3% return. 3% cost of debt. What does that mean? 15 minus 3, as you can see on the screen, that's a 400% return. Now, have you taken any risk with that? Take collateral for your private loan. I just used a simple example of a flip. It could be a private loan to anybody. As long as there's collateral involved and you have a loan to value below the market value, you're tremendously reducing your risk, and in some cases you can pretty much eliminate it. So what you can do is produce that crazy return simply by using other people's money. What's other people's money in this scenario? This is the insurance company's money, again, not yours. So what do? You get your money growing inside the policy, as we show there. It might be making 4 or 5%, depending on what the dividends are. And you're lending out the 90% and generating a return there. That is what we call magnifying your wealth.
Awesome. I think that'll wrap us up for today's probably shorter episode of the Magnify Wealth podcast. However, we will be right back on your screen next week. Have a great week, everyone.
Thanks. Have a great week.
Thanks for tuning in to the Magnify Wealth podcast with Scott Gannon. Remember to subscribe on YouTube or your favorite podcast platform for more insights on the infinite banking concept. Until next time, remember, immediate action is the most efficient way to achieve your goals.